The numbers never lie.
All right, let's dive into one of the most misunderstood strategies in all of investing, dividends. We're going to see how starting with just a few bucks a week can actually build a seriously powerful engine for your financial freedom. You know, when you hear the phrase dividend investing, what pops into your head? For a lot of us, it's this image of something, well, kind of slow, a bit boring, something our grandparents would do, right? It feels safe, sure, but definitely not exciting. The whole idea feels like it's this long, plodding road that only pays off way down the line. But what if that whole idea is just wrong? What if this so-called boring strategy is the actual secret behind some of the world's biggest fortunes? The truth is, dividend investing is an incredibly powerful tool for building wealth. Seriously. It's not just about collecting a few small checks here and there. It's about creating a machine that feeds itself and just grows faster and faster over time. So here's what we're going to break down. First, we're going to look at Warren Buffett's boring billions. Then we'll get into the magic of the compounding snowball. After that, we'll explore how you can build your very own dividend machine. And finally, we'll lay out a super clear path to financial freedom. Okay, let's start with the ultimate proof, the man himself, Warren Buffett. Now, pretty much everyone knows he's one of the wealthiest people on the planet, but very few people really get the core of how he makes his money. It's not about crazy trades or trying to time the market. Nope. It's a quiet, incredibly disciplined system built around one simple idea. Own great businesses that literally pay you to be an owner. This quote right here, this is the entire philosophy in a nutshell. Forever isn't just some catchy line for him. It's a real commitment. He's not looking for a quick buck. He's hunting for amazing businesses that he can own for a lifetime because he understands that real, lasting wealth is built by owning, not just by trading. Just look at this number for a second. Let it sink in. He started buying Coca-Cola stock back in the 80s, investing about $1.3 billion. Today, his company gets paid about $2.23 million in dividends from Coke every single day, and he's never had to sell a single share. The company just sends him a check for being a long-term owner, and that's just one of the companies in his portfolio. So what even is a dividend, really? Well, it's actually super simple. When a company makes a profit and has some extra cash, it can share that success with its owners, and that's you, the shareholder. Think of it like a thank you note from the company, with cash inside. For an investor like Buffett, this isn't just a nice little bonus. It's the most reliable kind of cash flow there is, because it comes from real profits, not just betting on which way the stock price will go. And his strategy, it's almost shockingly simple. It really just comes down to these four things. Find great companies that people are always going to need, think Coca-Cola or American Express, buy their stock when the price is fair, then just hold on through all the market's ups and downs for decades. And here's the kicker. Take all the cash they send you, those dividends, and use it to buy even more assets that produce income. It's a beautiful, powerful cycle of wealth. This analogy gets right to the heart of how successful investors think. You see, most people do the exact opposite of what actually works. They sell their best stocks to lock in a small profit. They cut the flowers. And they hold on to their losing stocks, just hoping they'll bounce back. They water the weeds. Buffett's whole philosophy is to do the reverse. Let your winners run, let them keep growing and paying you, and get rid of the businesses that just aren't working. Okay, so now let's talk about how all of this builds into something truly huge. We've seen Buffett's strategy, but the engine that makes it all go is something Albert Einstein supposedly called the eighth wonder of the world, compound interest, or, as we like to call it, the compounding snowball. It sounds almost too simple, but that's the beauty of it. When you get paid a dividend, you have a choice. You can take the cash and spend it, or you can reinvest it. And when you reinvest it, you buy more shares of the company. Well, those new shares, they start earning their own dividends. And that creates this amazing feedback loop where your investment doesn't just grow, it actually accelerates. Okay, let's just walk through this real quick. Let's say you start with $1,000. In year one, a 4% dividend gives you $40. Now, instead of pocketing that cash, you reinvest it. So in year two, you're not earning dividends on $1,000 anymore, you're earning them on $1,040. Your new dividend is $41.60. I know, it's a tiny increase, but it's so important. You reinvest that too. Now your little snowball is $1,081.60. It feels slow at first, I get it, but with every single cycle, it picks up a little more snow and it starts moving faster. And when you stretch this out over decades, that tiny snowball becomes an absolutely unstoppable avalanche of wealth. This really shows a fundamental shift in how to think about investing. Most people are obsessed with capital gains, buying low and selling high. That's kind of like chopping down a tree to get firewood. Yeah, you get value once, but the source of that value is gone forever. Dividend investing, that's like owning an entire orchard. You don't chop down the trees, you just collect the fruit they produce year after year, all while the trees themselves keep on growing. Okay, so the theory is solid, right? But how do you actually do this? The good news is you don't have to be Warren Buffett to build your own dividend machine. One of the easiest and, honestly, most effective ways to get started is with something called an exchange-traded fund, or ETF. It's basically a single investment that holds a whole basket of hundreds of dividend-paying stocks for you. But here's the thing, not all dividend ETFs are the same, not even close. They follow different strategies, and the right one for you really depends on your goals. Are you trying to get the most income you can right now? Or are you more focused on growing that income stream for the future? Let's look at two of the biggest players out there. So this slide shows you a really important trade-off. Over on the left, you've got DGRO, which focuses on dividend growth. It holds over 400 companies that are known for consistently increasing their dividends year after year. Now, the current payout or yield is a little lower, but look at that 10-year total return. It's higher. Then on the right, you have SCHD, which is all about high dividend yield. It's more focused, with about 100 stocks that pay a big dividend right now, almost 4%. The total return is a bit lower, but that immediate income is much higher. And the best part? They're both incredibly cheap to own. So here's the bottom line. There's no best ETF. It just depends on your timeline. If you're younger and you want to build the biggest possible snowball for the future, DGRO's focus on growth might be the better play for a higher total return. But if you're closer to retirement and you want more cash flow in your pocket today, SCHD's higher immediate payout might be exactly what you're looking for. And now for what I think is the most powerful part of all of this. We've seen the strategy, we've seen the tools. Now let's put it all together and map out a real, concrete path to financial freedom. And you might be shocked to learn that it can start with an amount as small as what you probably spend on coffee each week. Look, the strategy isn't complicated. It doesn't require being a stock-picking genius or trying to time the market. It just takes two things: consistency and patience. So we're going to model out what happens if someone invests just $200 a month. And I have to say, this does assume a hypothetical annual return that's in line with the market's long-term averages, so it's not a guarantee, but it's a perfect illustration of a principle that has worked for decades. This chart just says it all, doesn't it? It's the power of time. After 10 years of just putting that money away, the portfolio is worth over $52,000. That's a great start, but watch what happens next. In the next 10 years, it grows by almost $270,000. And in the 10 years after that, well, the growth just goes vertical. That is the compounding snowball hitting its stride. And that final number is it's breathtaking. Seriously, just take a second and let that number sink in. Over $2 million from just $200 a month. This isn't some get-rich-quick scheme. It's more of a get-rich-for-sure plan, built on discipline and the cold, hard math of compounding. It's proof that it's not about timing the market, it's about time in the market. But where did all that money even come from? This is where you can actually see the magic. So over those 30 years, you would have put in a grand total of $72,000. That's it. That's that tiny blue slice. All the rest, over 96% of your final portfolio, was generated by your money working for you. The stock prices going up accounts for about $1.3 million. And look at that green slice. Over $628,000 came from just reinvested dividends alone. Your dividends bought more shares, which paid more dividends, which created over $500,000 out of thin air. And this, right here, this is the end game. After 30 years, that $2 million portfolio could be spinning off over $10,000 in dividend income every single month. That is financial freedom. That's the point where you don't have to sell your assets to live anymore. Your assets pay your bills for you, forever. You've built your own personal cash flow machine. So, we'll just end with a question for you. We've seen the strategy, we've seen the tools, and we've seen the incredible potential. The math is simple, and the path is clear. It all just starts with that one small push to get the snowball rolling. The only real question left is, when are you going to start building yours?